In 1999, a man who built one of America's largest bookstore chains decided to reinvent the grocery store. He raised $800 million. He built a network of high-tech warehouses. He promised to deliver groceries to your door in 30 minutes. 2 years later, the company was bankrupt. $800 million. Gone. This is the story of Webvan. And it's not really about groceries. It's about what happens when you build the future before anyone wants it. It's about the difference between vision and delusion. It's about how confidence becomes indistinguishable from arrogance when you have enough money to ignore reality. Most people have never heard of Webvan. It came and went in less than 3 years. But the people who were there remember it as the purest distillation of everything that went wrong in the dot-com era. Not the dumbest idea, not the worst execution, the purest. Because Webvan wasn't a scam, it wasn't a joke, it was deadly serious, run by serious people, funded by serious investors, built with serious ambition, and it failed in a way that was so complete, so total, that it became a case study in what not to do. Let's start with the idea, because the idea wasn't crazy. Grocery shopping is a chore. Everyone knows this. You drive to the store, you find parking, you walk through aisles, you wait in line, you load the car, you drive home, you unload. It takes an hour, sometimes more, and you do it every week. What if you didn't have to? What if you could click through a website, select what you need, and have it delivered to your door? Fresh produce, meat, dairy, everything, in 30 minutes. That's not a small convenience. That's an hour of your life back every week. 52 hours a year. That's over 2 full days. People would pay for that, right? That's the question. And in 1996, when a man named Louis Borders starts thinking about this, the answer seems obvious. Louis Borders is not some kid with a website. He's a successful entrepreneur. He and his brother Tom built Borders Books from nothing into a national chain with hundreds of stores. They pioneered the superstore concept. They used sophisticated inventory systems when other bookstores were still using index cards. Louis Borders understands retail. He understands logistics. He understands technology. And he looks at the grocery business and sees inefficiency everywhere. Traditional grocery stores are expensive to run. The real estate, the utilities, the staff, all that floor space sitting there 24 hours a day, just so customers can walk around and pick items off shelves. What if you eliminated the store? What if you built warehouses instead? Highly automated warehouses, optimized for speed, with computer systems that route orders, guide workers, coordinate deliveries. You could do it faster than a traditional store, more efficiently, and eventually cheaper. The traditional grocery business operates on razor-thin margins, 2 to 3% profit on average, but they have massive overhead, expensive retail locations, wasted space, inefficient labor. A warehouse-based model could change the economics, higher margins, lower costs, better service. This is the vision. And when Louis Borders pitches it to investors, they see something bigger than groceries. They see the future of retail. Because if you can deliver groceries in 30 minutes, you can deliver anything. Groceries are the hardest product to deliver. They're perishable. They require different temperature zones. Fresh produce, frozen foods, dairy. If you can solve groceries, you can solve everything. This is 1997. Amazon exists, but barely. They only sell books. The idea that you can order physical goods online and have them delivered quickly is still novel. Exciting. Revolutionary. Borders isn't pitching a grocery delivery service. He's pitching the future of how people will shop. And the investors believe him. Benchmark Capital leads the Series A. This is not some random venture firm. Benchmark is elite. They funded eBay. They funded eBay at the Series A and made billions. They invest $10 million in Webvan in November 1997. 6 months later, Sequoia Capital joins, another elite firm. They funded Apple. They funded Cisco. They funded Yahoo, another $10 million. The validation continues. More rounds. More investors. By mid-1999, Webvan has raised over $100 million before launching a single market. $100 million. And they're just getting started. Here's what they're building. Not a website with some delivery vans. A system. Webvan designs custom warehouses. They call them fulfillment centers. Each one is 330,000 square feet. Highly automated. Conveyor belts. Carousels. Computer-guided picking systems. A traditional grocery store might have 40,000 square feet and carry 30,000 items. Webvan's warehouses are 8 times bigger and carry 50,000 items. The warehouses are expensive to build, $35 million each. But the efficiency is supposed to justify the cost. Each warehouse can process 8,000 orders per day. That's millions of dollars in daily revenue from a single location. At scale, the math works. At scale, the efficiency gains make traditional grocery stores obsolete. At scale. That word is doing a lot of work. The problem is, you need scale to justify the warehouse. But you need the warehouse to get scale. This is called a chicken and egg problem. And Webvan's solution is simple. Build the egg. Build the infrastructure. Build it properly. Build it to handle the demand you'll have in the future. If you build it, they will come. This is not entirely unreasonable. Amazon did it. They built infrastructure before they needed it. They lost money for years investing in warehouses and systems. Now they're one of the most valuable companies in the world. So Webvan builds. In May 1999, they launch in the San Francisco Bay Area. The first market. The test case. The website goes live. Customers can browse 50,000 items. Order online. Schedule delivery in 30-minute windows. Same-day delivery available. The warehouse in Oakland is operational. The delivery vans are ready. The customer service team is trained. The response is enthusiastic. People love it. The selection is better than most stores. The interface is easy. The delivery is reliable. Orders start coming in, hundreds per day. Then thousands. But there's a problem underneath the good news. Each order is losing money. The average order is around $80. The cost to fulfill and deliver that order is somewhere between $27 and $30. So you're spending $30 to generate $80 in revenue. That sounds fine, until you remember that the groceries themselves cost money. The gross margin on groceries is about 25%. 25% of $80 is $20. You're making $20 and spending $30. Every order loses $10. And that doesn't include the cost of the warehouse, or the technology, or the marketing, or the salaries. The more orders you get, the more money you lose. This is exactly what happened with Pets.com, except worse. Because Webvan isn't just losing money on customer acquisition. They're losing money on every single transaction, even with repeat customers. The solution, according to the business plan, is volume. At higher volume, the delivery costs per order decrease. You can bundle multiple orders on each delivery route. You can spread the warehouse costs across more orders. The fixed costs become less significant as revenue grows. It's logical. It's how scale businesses work. But there's a detail that should have mattered more. To get the volume, you need customers. To get customers, you need to advertise. To advertise in a new market, you need brand awareness. Traditional grocery stores don't face this problem. They open a location. People drive by. They see it. They go in. Webvan is invisible. You're at home. You're not driving by a Webvan. You have to know it exists and choose to use it instead of the store you've been shopping at for years. That takes marketing, expensive marketing. And groceries are not the kind of product that inspires loyalty based on brand. People are loyal to convenience, price, habit. If Webvan is convenient enough and cheap enough, they'll use it. If not, they won't. So Webvan needs to be both convenient and cheap, while spending $30 per order on fulfillment and delivery, while building $35 million warehouses. The math is getting difficult, but the money keeps flowing, because it's 1999. And in 1999, money flows toward big visions, regardless of current profitability. Webvan decides to expand. Fast. They announce plans to enter 26 markets within 2 years. 26. Each market needs a warehouse. $35 million. 26 markets. That's $900 million in warehouses alone. This is not a typo. $900 million. Before they've proven the model works in a single market. Why would anyone do this? Because in 1999, the biggest risk is not expanding fast enough. The biggest risk is letting a competitor get there first. And Webvan has competitors. Peapod is already delivering groceries in several cities. Home Grocer has raised significant funding. Cosmo is delivering snacks and videos. Everyone is racing to become the Amazon of their category. And everyone believes that whoever gets big, fastest wins everything. Winner takes all markets. Network effects. First mover advantage. These are the phrases that justify any level of spending. So Webvan builds Atlanta, Sacramento, San Diego, Dallas, Seattle, Portland, Chicago, Los Angeles, Orange County, suburban New Jersey, Washington, D.C., market after market, warehouse after warehouse, before they figured out the unit economics in San Francisco. In July 1999, before most of these markets have launched, Webvan announces something extraordinary. They're going public. The IPO is set for November. The company will be valued at over $4 billion. $4 billion for a company that's operating in one city and losing money on every order. But this is not unusual in 1999. This is normal. Expected. Celebrated. The S-1 filing, the document that companies submit before going public, is revealing. For the first 9 months of 1999, Webvan generated $9.4 million in revenue. They lost $35 million. They're very clear about the plan. They're going to keep losing money for years. They need to build infrastructure. They need to acquire customers. They need to reach scale. The prospectus lists the risks. Pages and pages of risks. The business model is unproven. Competition is intense. Profit is uncertain. Every risk that will eventually destroy the company is right there in the filing. But no one cares. Because the story is too compelling. The vision is too big. The opportunity is too massive. The IPO happens on November 5th, 1999. The stock is priced at $15. By the end of the first day, it's trading at $25. The company is now worth $4.8 billion. Louis Borders owns shares worth several $100 million. On paper. The employees have stock options that make them millionaires. On paper. Everything is perfect. On paper. The reality is different. In the markets they've launched, orders are growing, but slower than projected. Much slower. In San Francisco, where they've been operating for 6 months, they're doing a few thousand orders per week. The warehouse can handle 8,000 per day. They're using a tiny fraction of their capacity. This matters because the efficiency of the model depends on high utilization. An empty warehouse is just expensive overhead, and the customer acquisition costs are brutal. They're spending millions on advertising in each market: direct mail, radio, television, partnerships with corporations. Getting customers to try the service once is expensive. Getting them to come back regularly is even harder, because people have routines. They shop at the same stores. They know the layout. They know what's on sale. They know what they're doing. Changing that behavior requires either significantly better service or significantly better prices. Webvan offers good service. The deliveries are reliable. The selection is extensive. The website works. But it's not transformatively better. It's incrementally more convenient. And the prices can't be lower. They're already losing money at current prices, so they're stuck in the middle. Better than traditional shopping, but not enough better to justify changing habits for most people. The customers who do use Webvan love it. The Net Promoter Score is high. Customer satisfaction is excellent. But the total addressable market of people who will pay for this level of convenience is smaller than the projections assumed. Much smaller. This is becoming clear by early 2000. But by early 2000, they've already committed to building warehouses in 24 cities. The construction continues, the spending continues, the losses accelerate. In the first quarter of 2000, revenue is $17.5 million. Losses are $40 million. They're spending more than twice what they're making. And then the market crashes. It starts in March. The NASDAQ peaks on March 10, 2000 at 5,048. It will lose half its value by the end of the year. Internet stocks are decimated. Companies that were valued at billions are suddenly trading at a fraction of their IPO price. Webvan's stock drops from $25 to $10, then to $5. The funding environment changes overnight. 6 months ago, you could raise unlimited money with a PowerPoint presentation. Now, investors want to see a path to profitability. Profitability. That word hasn't mattered in years. Suddenly, it's the only thing that matters. Webvan tries to adjust. They announce they're slowing expansion. They're focusing on existing markets. They're cutting costs. But the machine they built is designed for growth. When you stop growing, the economics get worse, not better. Because the warehouses have fixed costs: rent, maintenance, staff. Whether you do 100 orders a day or 8,000, those costs don't change much. At low volume, the cost per order is astronomical. At high volume, it's merely bad. They need volume. But getting volume requires spending on marketing, and they're trying to cut spending. There's no good option. By mid-2000, the situation is critical. They're burning through tens of millions of dollars per quarter. The stock price is below $3. Capital markets are closed. They try to raise more money. Private investors, strategic partners. Anyone. No one is interested. In July 2001, Webvan announces they're shutting down. Immediately. Not winding down. Not restructuring. Shutting down. The warehouses close. The deliveries stop. The website goes dark. 12,000 employees lose their jobs, most of them on the same day. The total amount of money destroyed is difficult to calculate precisely. Over $800 million in invested capital. Billions in market value evaporated. The bankruptcy filing lists $300,000 in remaining assets, mostly office furniture. $800 million became $300,000. That's not a business failure. That's a bonfire. So what happened? The standard answer is, they grew too fast. They spent too much. They didn't prove the model before scaling. All of that is true. But it's not the whole story. Because the decision to grow fast wasn't random. It was deliberate. It was based on a theory about how markets work. The theory was, in a network business, the first company to reach scale in each market wins that market. Permanently. If Webvan could get to 5 markets before Homegrocer, they'd own those markets forever. Customers would use Webvan. Webvan would get better and cheaper through scale. Competitors wouldn't be able to catch up. This is how Amazon won books. This is how eBay won auctions. This is how network businesses work. Except grocery delivery isn't really a network business. There's no network effect in having more customers in Seattle that makes the service better for customers in Dallas. There's no winner-take-all dynamic. You can have multiple grocery delivery services in the same market. The only advantage of scale is cost efficiency, and that only matters if you can actually achieve the scale. Webvan built for a future that required millions of regular customers. They had tens of thousands. The gap between the world they built for and the world they operated in was too large. Here's the more uncomfortable truth. The problem wasn't execution. The problem was the idea itself. Grocery delivery at the level Webvan attempted requires massive infrastructure investment. That investment only makes sense at enormous scale. But getting to that scale requires changing consumer behavior fundamentally. Changing behavior is expensive, slow, uncertain. You can't force it with money. You can't accelerate it with advertising. People change habits when the new way is so much better that not changing feels stupid. For some people, Webvan was that much better. For most, it wasn't. The people who loved Webvan really loved it. Working parents, busy professionals, people with mobility issues. They saved hours every week. But that population wasn't large enough to support the infrastructure Webvan built. A sustainable business would have started small. One warehouse, one market, modest delivery fleet. Prove the economics work at small scale. Then expand carefully. Grow revenue before growing infrastructure. This is how most successful businesses are built. Slowly, sustainably, boringly. But in 1999, that approach wouldn't have raised $800 million. It wouldn't have attracted the talent. It wouldn't have gotten the attention. The only way to get the resources to try something this ambitious was to promise to do it impossibly fast. So they did. Louis Borders believed he could reinvent an industry. He'd done it before with bookstores. He had the credentials, the track record, the intelligence. And he was right that the grocery industry was inefficient. He was right that technology could improve it. He was right that people would value convenience. He was just wrong about how fast it could happen, and how much it would cost, and whether the economics would ever actually work. Those are significant errors. But here's what's strange. The investors who funded Webvan were sophisticated. They had teams of analysts. They had experience. They'd seen businesses fail. They knew the risks. The S-1 filing spelled them out explicitly. So why did they invest? Because they had to. In 1999, if you're a venture capital firm and you don't invest in the internet grocery space, and that space takes off, you've missed the next Amazon. Your investors will fire you. The fear of missing out was stronger than the fear of losing money. And the potential upside was enormous. If Webvan worked, if it became the dominant grocery delivery platform, it would be worth tens of billions. A $50 million investment returning $10 billion. That's a 200x return. Those returns justify taking huge risks on uncertain businesses. The math makes sense from the investor's perspective. The problem is when everyone does the same math at the same time. When every firm is competing to invest in the same space. When the question is not whether to invest, but how much and how fast. Then the discipline breaks down, the standards lower. The skepticism disappears. Everyone becomes a believer because belief is the only way to get in. This is how bubbles form, not because everyone is stupid, but because everyone is competing to not miss out. Webvan went public in November 1999 at a valuation of nearly $5 billion. 6 months later, the company was worth less than $1 billion. A year after that, it was bankrupt. $5 billion to zero in 20 months. But the interesting thing is that the idea didn't die. Today, grocery delivery exists. Instacart is a multi-billion-dollar company. Amazon Fresh delivers groceries. Walmart delivers groceries. Every major grocery chain offers delivery. Webvan was right about the demand. People do want groceries delivered. So was Webvan just early? That's the comfortable answer, the one that lets everyone involved feel better about what happened. But look at how the successful companies do it. Instacart doesn't own warehouses. They partner with existing stores. They use gig workers for delivery. They have almost no fixed costs. Amazon Fresh uses their existing logistics network. They leverage infrastructure they already built for other purposes. Walmart uses their stores as fulfillment centers. They already have the buildings, the inventory, the systems. None of them built custom $35 million warehouses before proving demand. They started small. They tested. They proved economics at small scale. Then they grew. This is not revolutionary thinking. This is basic business strategy. But in 1999, basic business strategy was for people who didn't understand the internet. The believers understood that the internet changed everything, that the old rules didn't apply, that you had to move fast and think big. And if you questioned that, you didn't get it. The problem is that the internet didn't change everything. It changed some things. But groceries still had weight. Delivery still cost money. Profit margins were still thin. The fundamentals still mattered. Webvan's autopsy is taught in business schools now. The case study has a simple lesson. Prove the model before you scale. But that's too simple. Because everyone involved knew that lesson. They just chose to ignore it. They ignored it because the incentives rewarded ignoring it. You don't raise $800 million with a modest plan. You don't go public at a $5 billion valuation by being careful. You do it by promising to change the world, by selling a vision so big that it justifies any level of investment. And in 1999, everyone wanted to believe in big visions. The venture capitalists wanted to find the next Amazon. The executives wanted to build something historic. The employees wanted their stock options to make them rich. The public markets wanted the next great growth story. Everyone had a reason to believe. Until the money ran out. There's a video that still exists online. It's from 1999. Louis Borders being interviewed about Webvan. He's articulate, confident, passionate. He talks about the efficiency of the warehouse system, the sophistication of the routing algorithms, the quality of the service. He's not lying. He's not exaggerating. He believes every word. You can see it in his eyes. This is a man who knows he's building something important, something that will change how people live. And watching it now, knowing how it ends, you don't see a fool. You see someone who was so certain of his vision that he couldn't see the problems. The certainty was his strength. It's what got people to believe in him. It's what got investors to write massive checks. It's also what destroyed the company. Because certainty makes you inflexible. When reality conflicts with your vision, you assume reality is wrong. The Bay Area launch had problems. Okay, that's the Bay Area. It's a test market. The customer acquisition costs are high. Okay, they'll come down with scale. The orders aren't growing as fast as projected. Okay, we need more marketing. The unit economics aren't improving. Okay, we need more volume. Every problem had the same solution. More scale, more spending, more time. Never. Maybe the fundamental model doesn't work. This is called the sunk cost fallacy. You've invested so much that you can't admit it was wrong. Every problem becomes a reason to invest more. Until you run out of money. Webvan burned through $800 million in less than 4 years. Most of it in the last 2 years. Most of it on infrastructure that was never fully utilized. Empty warehouses, delivery vans sitting idle, systems designed for 8,000 orders per day getting a few hundred. All that investment, all that technology, All that ambition, worthless, because they built the future before the present was ready for it. There's a deeper question underneath all of this, a question about what we believe and why. In 1999, the story everyone believed was that the internet would replace physical retail. That convenience would trump everything else. That technology would make traditional business models obsolete. This wasn't a crazy story. Parts of it were true. Books, music, movies moved online. Shopping changed fundamentally. But the story was too simple. It assumed that if technology could do something, people would want it done that way. Grocery delivery was possible. The technology existed. The logistics could work. But that doesn't mean people wanted to give up walking through a store, picking their own produce, seeing what's on sale, making impulse purchases. Shopping is not just about getting products. It's about control. It's about ritual. It's about the experience. Webvan treated grocery shopping as a problem to be solved. Get the items to the customer as efficiently as possible. But for many people, it wasn't a problem. It was just something they did. The people who loved Webvan were the people for whom shopping genuinely was a problem, who hated it, who had better uses for their time. That's a real market. But it's not everyone. Webvan needed everyone. This is the trap of revolutionary ideas. They require mass adoption to work. But mass adoption requires the idea to be so good that it changes behavior for most people. Most revolutionary ideas aren't that good. They're incrementally better. Nice to have, helpful for some. That's not enough to justify building $35 million warehouses in 24 cities. The bankruptcy auction was bleak. The assets sold for essentially nothing. The warehouses were bought by other companies for a fraction of what it cost to build them. The technology, the systems, the software. All of it had value in theory. None of it could be separated from the failed business model. The sock puppet from Pets.com became iconic, a symbol of the era. Webvan had no puppet, no memorable character, just a clean website and efficient service and tremendous losses. It disappeared quickly. Most people who weren't directly involved forgot it existed. But the people who were there didn't forget. 12,000 employees lost their jobs. Many of them had turned down safer positions to join something exciting, something revolutionary. They believed in the vision. They worked long hours. They did everything right. And they watched it collapse in real time, watching the stock price drop, watching the orders plateau, watching the cash burn reports get worse, knowing it was ending before it was officially over. That's the human cost of failed visions. Not just the money, the time, the belief, the hope. All those people who could have been building something sustainable, working on something that had a chance. Instead, building infrastructure for a future that never arrived. The lesson from Webvan is usually framed as, don't scale prematurely. But that's not quite right. Because Webvan didn't accidentally scale too fast. They chose to scale too fast, because that's what the market rewarded. The real lesson is about incentives. When the system rewards growth over sustainability, when it rewards vision over profit, when it rewards confidence over caution, you get Webvan. You get brilliant people making terrible decisions, because those decisions are what the environment demands. Change the incentives, change the outcomes. But that's harder than blaming Webvan for bad execution, because changing the incentives means changing how we fund companies, how we evaluate success, how we think about growth. It means accepting that most great businesses are built slowly. That sustainable growth is more valuable than explosive growth. That profitability matters from the beginning, not eventually. Those are boring truths. They don't inspire. They don't excite. They don't raise $800 million. But they build businesses that last. Today, if you want groceries delivered, you have options. Real options. Services that work, that are sustainable, that aren't burning billions of dollars. The idea that Webvan pioneered is now ordinary, normal, expected. But the path to get there wasn't through Webvan. It was around them. Past them. Over their expensive, efficient, empty warehouses. The future arrived, just not the way they built for it. In July 2001, when Webvan announced they were shutting down, the press coverage was extensive. Another dot-com failure. Another $1 billion gone. But buried in the articles was a detail that's easy to miss. They still had customers, thousands of them. Regular users who depended on the service. When Webvan announced it was closing, these customers panicked. They'd built their routines around it. They'd stopped going to grocery stores. And suddenly, with a few days' notice, they had to figure out a new way to shop. The service worked. The customers were satisfied. The need was real. The business just couldn't make money. That's the tragedy. Not that the idea was bad, but that the execution was so expensive, so ambitious, so certain of immediate mass adoption that it couldn't survive the time it needed to actually work. If Webvan had started with one warehouse, one city, a small fleet, modest ambitions, if they'd grown slowly, carefully, proving economics at each stage before expanding, if they'd prioritized sustainability over speed, they might still exist. They might be what Instacart is now, a successful company that changed how people shop. But they couldn't do that, because doing that wouldn't have raised $800 million. And without $800 million, they couldn't build the system they envisioned. So they had a choice. Build something modest that might work, or build something revolutionary that probably wouldn't. They chose revolution. In 1999, a man who built a successful bookstore chain decided to reinvent the grocery store. He raised $800 million. He built state-of-the-art warehouses. He promised to deliver your groceries in 30 minutes. He was right about the demand, right about the opportunity, right that the technology could work. He was just wrong about everything else. The timing, the costs, the speed of adoption, the willingness of people to change their habits, all the details that turn a good idea into a sustainable business. Webvan doesn't exist anymore. The warehouses were sold. The systems were abandoned. The vision dissolved. All that's left is the lesson. The same lesson from every bubble. The same lesson that gets forgotten every time. You can't build the future faster than people are ready for it. You can't force adoption with money. You can't ignore fundamentals because you have a vision. And most importantly, you can't confuse what could be with what is. The question isn't whether Webvan failed. The question is why everyone was surprised when it did. The answer was in the numbers from the beginning, in the unit economics, in the customer acquisition costs, in the gap between the infrastructure they built and the demand that existed. But no one wanted to see it, because seeing it meant acknowledging that the vision was too big, too early, too expensive. And in 1999, that kind of thinking didn't raise $800 million. That kind of thinking got you left behind.